There's something scary happening in the investment world right now, and not a lot of people are talking about it. It's the spread between the 2 and the 10-year Treasury. I'm going to tell you why it's so important that you need to know about it and why it tells us that the stock market is about to crash. So if you're new to my page, hit the subscribe button below. If you really like what I have to talk about, hit the notification icon as well. Essentially what we're talking about today though is the 2 and 10-year spread. Now this is a huge problem because before the last 7 recessions, before the last 7 major market corrections, there was an inversion in the yield of the 2-year and the 10-year US Treasury. And that is why it is so important that we pay attention right now to these little details in the economy. Move your investments out of the ultra high risk stocks and mutual funds that you have, and you say, oh, it's in my retirement, it's fine. Your mutual fund is made up of a fund of funds, which is made up of more funds. And if you look on those underlying funds, they're just made up of international stocks, domestic stocks, small cap, mid cap, and large cap stocks. And probably very small exposure to bonds. And the bonds you have are probably corporate bonds. And corporate bonds are very volatile. I'm encouraging you to actually look at your retirement, your 401k, look at the mutual fund. I moved all of my 401k retirement into the one quality or safety bet that is inside of my option in Vanguard, and it's a money market account. The 3-month and the 10-year yield inverted just a few months ago, and it made a lot of noise. But ever since then, everyone's been kind of just backing off on the whole yield curve inversion conversation. What is happening with the 10-year? It's down to 1.73%, and the 2-year is 1.6%, which means the spread between the payout or the interest rate on a 2-year bond versus a 10-year bond is only 13 basis points. As a refresher, a basis point is 100%, meaning that it's only 0.13% difference between the payout and a 2 and a 10-year Treasury. Now, what this means specifically is, if you think about it logically, if I give the US Treasury $1,000 for 10 years, I expect a really nice interest rate on that. You know, if I put my $1,000 in the stock market for 10 years, I would probably expect it to double. But if the US Treasury over the 10 years is giving me 1.73, that's not that great. Well, then I would expect the 2-year Treasury to be really bad. If the 10 years only 1.7% interest, then the 2-year must be like 0. Or if you saw my other video, negative interest rate. But wait a second, the 2-year pays almost the same, 1.6% interest rate. So you're telling me that I could put my money in a US Treasury for 2 years and have almost the same payout as if I put my money in the Treasury for 10 years, 5 times longer? That's a huge red flag, okay? Not only is it a huge red flag, but slowly over the last 10 years, and specifically the last 12 months, the gap between the payout of the 10-year and the 2-year is getting smaller and smaller and smaller and smaller. And that's called the 2 and the 10-year Treasury spread. And when the difference between the 10-year and the 2-year becomes nothing or 0, that's called a flattening of the yield curve. That means it doesn't matter if you invest essentially for 3 months, a year, 2 years, 5 years, or 10 years. It all pays out the same. And that's a really scary phenomenon, because essentially that leads to the next step, which is an inverted yield curve. An inverted yield curve means that the 10-year Treasury is going to sink below the current 2-year Treasury note. The Federal Reserve, Jerome Powell, lowered the interest rate for the first time in a decade. That was a red flag. The global debt crisis of negative interest debt, meaning that people are actually buying debt, for example, a German Treasury bond, which pays a negative interest rate. They're willing to buy a bond, even though it pays out a negative interest rate, because they would, it's essentially guaranteeing them safety, a safe place to put their money. Another vlog I made about Warren Buffett and his cash reserves at Berkshire Hathaway, over 120 billion, because he has nothing he can buy. There's no values on the marketplace. So all of these little things are starting to percolate, and we need to make notice of it. And so, historically speaking, when the 2 and the 10-year invert, there is very little time, only maybe like 9 months until the market completely collapses. So we know we basically have 9 months to save up as much cash as we possibly can. And we have essentially a very short runway to do what the wealthy do and fly to safety, flight to quality. And I had to look inside of all these different investment options. There's like 15 of them, not that much. And this particular money market account said it tracked treasuries. And so I had to see which treasuries. And it actually said US Treasuries and 99% treasuries or cash equivalents. And you have to do that because there are some money market accounts that say they track treasuries, but in reality, it will be like 20% treasuries, 20%, bonds, corporate bonds, municipal bonds. And I love to make fun of Tesla, but go buy a Tesla bond. It pays 8%, right? Nothing wrong there. Bonds are safe. No, bonds aren't always safe. A Tesla bond is a junk bond. So just because it has the word bond associated with it doesn't mean it's a safe investment. So right now, preserve your wealth, preserve your liquidity like the wealthy. So in conclusion, the 2 and the 10-year are getting really close to being the same payout. And what that means to us as younger, newer investors wondering what we do with our money, it basically means that there's a huge red flag in the marketplace, that there is very high demand for these 10-year treasury bonds, that massive investors are buying in to the 10-year treasury, and it's lowering and lowering and lowering the interest that treasury pays out. It's a supply and demand functionality there. And so that's just telling us that there's so much demand in the global economy or the global markets for safe investments that it's pushing down the value of the 10-year. What we need to take away from this is that the 2-year and the 10-year are getting really close to the same payout, the same interest rate. And that's scary because we want a long-term investment to pay way more than a short-term investment. But that's not the case anymore. A 10-year interest rate is now almost the same as a 2-year interest rate. And as soon as the 2-year interest rate starts to pay more than the 10-year interest rate, then we have something seriously to be concerned about. So if you like what we talked about today, hit the subscribe button below. If you really like what we talk about, hit the notification button as well. See you next time.